Am I obligated to fund an IUL, Index Universal Life, in 5 years? Now, there's a reason why people ask this question, because they see a lot of illustrations in my books or on this YouTube channel of clients that are 55 to 75 years old that actually fund their IUL as fast as the IRS allows, which is usually 5 years if you're 50 or older. If you're under age 50 and you have lump sums, you can do it in as little as 4 years, okay? But it poses the question, well, am I obligated to do that? No. You could fund it in 7 years, 12 years, 30 years, okay? And so what if I don't get it funded in that time frame? That's not the end of the world. It would behoove you to fund it as fast as possible. But we have many, many people who fund IUL for 10 years, 20 years, 30 years. And so stay with me. I'm going to show you different examples. But if you have lump sums right in your hands and you're wanting to reposition it, the fastest, if you were in your 50s, would probably be in 5 years, or what I call 4 years in one day. Get ready, you'll understand why. So I'm Doug Andrew. I've been a financial strategist and retirement planning specialist now for 5 decades, helping thousands of Americans optimize their assets, minimize taxes, and prepare for a comfortable retirement so they will not outlive their money. Because of that, my sweet spot of clients, okay, the people that I probably devote most of my time and attention helping are those people who have been around the block, they've accumulated money, and now they've painted themselves into a corner, what I call a tax trap. And so those are the ones that I need to sort of rescue and free from that tax trap. So most of my clients through the years are those people that are just preparing to retire. They're usually between the ages of 55 to age 75. Many of them are 78, 79, 80. And that's my most common client. And first of all, maybe that's a surprise to you. A lot of people think when they're 60 or 70 that they're too old. No, they're not too old, because once you understand maximum funded IUL, it doesn't matter how old you are or even how unhealthy you are, because you can get away with less insurance the older you are, and the more unhealthy you are, you can get away with less insurance. So the rate of return, the cost of insurance is the same. Did you hear that? You need to check out several episodes on my channel to understand that. The amount of insurance required is less the older you are and the more unhealthy you are. And I prove this that in my books and on my channel. It doesn't matter if you're a 22-year-old athletic marathon running female, or if you're a 60-year-old, or if you're a 78-year-old that I give the example of, a friend of our family, who at age 78 had 3 blocked arteries, adult onset diabetes, a prostate cancer episode, 6 sisters, all predeceased him, and 3 brothers predeceased him. But he was still insurable, okay? And so he was rated Table D, which means the cost of insurance was double for him at age 78 as a normal 78-year-old. He was actually had the life expectancy of a 83-year-old. We were able to squeeze down the death benefit so that he could get the same rate of return as a 20-year-old, okay? He could earn 11 and net 10, which is what he did back in the 1980s. He put in $500,000 and immediately started pulling out $50,000 a year, a 10% payout, tax-free, because the cost of insurance was the same for him at age, effective age of 83, as it was for a 20-year-old. You wouldn't believe how many insurance agents do not understand what I just said, but you usually, after 1988, the TAMRA law was passed June 21st of 1988. TAMRA is the Technical and Miscellaneous Revenue Act. And so we could no longer maximum fund an IUL policy, or back then it was just universal life, in one single premium and immediately start taking out tax-free income. You had to spread out the premiums over 5 years, generally speaking. If you were 50 years old or older, if you were younger than that, you could maximum fund or get most of the premium allowed by the IRS in the first 4 years, or 3 years and 1 day if you get technical, if you're going to put in lump sums the first day of each year, okay? Now, so most of my illustrations for those ages show people with a lump sum. Let's use that example of $500,000. They come to me and they have $500,000 they want to reposition in order to optimize that money, those assets, by increasing the liquidity, the ability to access your money, the safety. They don't want to jeopardize their money when the markets go down, so they want it out of the market. They want to earn the best rate of return possible, and they want tax advantages. So when you can increase liquidity, safety, rate of return, and tax advantages, that's optimizing those assets compared to where they had it, where it was not passing liquidity, safety, rate of return, and tax advantage tests, as well as an IUL can. You got it? So people may come to me and when they want to reposition money they had in IRAs or 401ks in the market. They may have money in some rental properties. They're sick and tired of taking out the trash and fixing toilets and evicting tenants. They want to sell that rental home and take the equity and put it here. They have money in banks and credit unions earning pathetic returns of 3%, and that's not keeping up with inflation. So they may come in and they want to reposition $200,000 from selling a rental home, $200,000 from IRAs or 401ks after tax, and $100,000 they have in banks and credit unions. We add those up and that's $500,000, okay? So they come to me and they have $500,000 they want to reposition. Well, ever since June 21st of 1988, they can't put that into an IUL policy all at once and take the least amount of insurance, or else it will create a MEC, a modified endowment contract, meaning the money only grows tax deferred, but if they want to take out tax-free income, which most people want, now it's taxable. So they have to comply with TAMRA. So the fastest they could put in that $500,000, if they're in their 50s or older, would be maybe 20% a year. So I'm just rounding, but that would be $100,000 a year for 5 years. Now, technically speaking, they could put in $100,000 the first day of the first year, the next $100,000 the first day of the second year, first day of the third year, first day of the fourth year. The first day of the fifth year is actually 4 years and 1 day into that policy. Now they have their $500,000 into the policy, okay? So naturally, people see that in illustrations, and they see that you have to comply with TAMRA, which means the fastest you can fund it if you're older is maybe 5 years. If you're younger, you can get in that $500,000 closer to $125,000 a year for 4 years, okay? Or 3 years and 1 day, okay? So if you're younger, you can get in the money faster. The point is this: they see these illustrations and they sort of think, okay, you've got to fund this thing in 5 years. Well, naturally, some people say, well, am I obligated to fund an IUL in 5 years? No, that's the fastest you could fund it. You could take 10 years, you could take 7 years, 10 years, 15 years. You could sock away $10,000 a year, okay? And you could do that for 50 years to put in the $500,000, okay? But you can put in a certain amount of premium each year for, you calculate the first 11 years to find out the minimum death benefit under TEFRA and DEFRA, and that's called the guideline single premium. And if you just put in the same amount every year thereafter, you're allowed to put in, let's say $1,000 a month, $12,000 a year. You times that by 11 years, that's $132,000. Well, you can put in more than $132,000, but you can only put in the same amount, $12,000 a year, in the 12th year, the 13th year, the 14th year. Any year you don't put it in, you can make up for that. Now, if you decided to put in the full amount, the full $132,000 you were going to put in over 11 years, and you put it in 5 years, you have to stop. If you have more money, you have to take out another IUL. If you make a material change by increasing the death benefit on your existing one, then all of the grandfathering that you had, if Congress changed the tax laws, don't apply with the old one. So normally, if you have more money, then you can accommodate into the policy, and you get it in there in 5 or 6 or 7 years, and you have to stop, but you have more money. It would behoove you to take out another IUL policy than to make a material change by increasing the death benefit on that existing one. If you're younger, you could accommodate more money by using the increasing death benefit. But for older people, we recommend the level death benefit to make the cost of insurance become cheaper as you get older, okay? A properly trained IUL specialist will help you understand what is best. But the answer to this question is no. You don't have to fund it in 5 years. If you designed it to accommodate $100,000 each year for the first 5 years and stop, you don't have to. You could put in $100,000 the first year, and you could actually coast for probably 10 years without putting in anything, because you probably put in 10 times more than you needed to cover the actual costs. So you put in $100,000, the actual cost of insurance might only be $10,000. So you actually put in 10 times more than you needed to because you were maximum funding it. So you're not obligated to put in the next 100, the next 100, the next 100. It would behoove you to do that, but you're not obligated to. You could coast for 10 years. You could put in 100,000, coast for a year or two, and then if you have the money, you could put in 200,000 or even 300,000 if you have that much room that you haven't used now, because you can make up for a room that you didn't use. Did you hear that? And so, but you're not obligated to get it funded within the first 5 years. Would it be best if you did? If you have the money, yes. But don't worry if you don't. You can maximum fund that in 6 years, 7 years, 10 years, 12 years. And then when you're done, especially if you're younger and you started out with the increasing death benefit, you switch over to the level death benefit once you have finished funding the policy. And then the cost of insurance will actually go down. It will get cheaper as you get older, okay? So the second part of this question, what if I don't get it funded in that time frame? No big deal. You don't choose investments based upon which ones grow the most in 5 years. You choose the investments that are going to generate the most at the time in life you're going to need the money the most. So if you're funding it and you do it in 5 years, 7 years, 10 years, 12 years, and then you're going to let it sit and grow, and you're starting out at age 45, but you're not going to start taking out income until age 65, that's 20 years down the road. So you don't have to get it funded in 5 years. Even if you started out with that in mind, if you're 50 or 55 and you think, okay, I'm gonna put in 500 grand in 5 years, and something comes up, and you need to use it for something else, you can make up for that, and you can put in the money in the 6th year, 7th year, 8th year, 10th year, or whatever in the future. What if you don't ever maximum fund it? Well, then you can squeeze down the death benefit if you don't care to make sure that the money you did put in grows at the best net internal rate of return. But that's an irreversible change if you lower down the death benefit to lower your costs. Many times, after a certain number of years, we purposely lower the death benefit to lower the cost. A properly trained IUL specialist will show you how to do that. But generally speaking, you are not obligated to maximum fund an IUL policy in 5 years. That's if you want to get it to have the best net internal rate of return as quick as possible, so that if you average 11, you can net 10, or if you average 9, you can net 8. As soon as possible, it would behoove you to maximum fund it as soon as you can. But you're not obligated to, okay? These are flexible. I have a beatitude, blessed are the flexible, for they shall not be bent out of shape. And so if you don't get it funded in 5 years, no big deal. You might earn 11 and not net 10 within, a 12 or 15-year time period or 20-year time period. Maybe you'll earn 11 and net 8 or 9 in that time period. But at the end of the day, if you maximum fund it and you go clear out to age, 95, 100, or age 120, your net internal rate of return will probably still be within 1% of the gross rate of return, even if you took 10, 12, 15 years to fund it. You will see that when a properly trained IUL specialist will show you the net internal rate of return analysis, okay? I can't believe how many insurance agents don't know how to do this. We have software that we use, that we developed to do this. And you'll see that it's not that big of a deal if you don't get it funded in that time frame. you can make up for lost time is what I'm saying, okay? So if you want to see examples of this and learn more, the first thing I would recommend is you study my most recent best-selling book, The Laser Fund. It's 300 pages, jam-packed with charts, graphs, and explanations. On the left brain side, if you like the stories and examples, you're a right brain learner, you flip it over to this side and just cut to the chase and read 62 actual client stories. If you want to use your left brain and your right brain, read both of these books, 300 pages. This retails for $20 up to $70 on Amazon. If you buy it on Amazon, thank you, but I'll give you a copy free. So simply click on the link below or go to laserfund.com and you contribute a nominal amount toward the shipping and handling. I'll cover the rest of that cost, and then I'll pay for the book. I'll fire out a hard copy to you via priority mail. When you're in there claiming your free copy, if you like to listen and learn or watch and learn, there's audio and video formats available. There's a master class you can watch. You can also schedule for a free 90-minute webinar, a free Retire by Design 6-hour learning experience. You can even schedule an appointment with an IUL specialist to see how property designed laser fund can be done in several different scenarios, funded in 5 years, 7 years, 10 years, 12 years, or over 20 years from a specialist who knows what they're doing. It would behoove you to see an illustration like that. You don't want to make the mistake of not having it done correctly. You want to maximize your return, minimize expenses over the life of the IUL contract.